A very good morning to Dr. Saiful and everyone. We are from Group 3 and here's the list of our group members. Generally, we know that a portfolio is a collection of financial investments like stock, bonds, commodities, cash, and cash equivalent, including closed-end funds and exchange-traded fund. Before investing in any assets, for sure, we need to make some survey, strategy, and consideration to determine the potential assets in forming a portfolio that suits our choice of risk. In this project, 6 companies from different industries have been chosen, which is Tenaga Nasional, Kobe Technology, Axiata, Sapura Energy, Pan Malaysia's Holding, and Eucris. Each of the company's returns are analyzed through descriptive statistics in order to choose the best company shares to include in the portfolio. Then we apply the Markowitz portfolio optimization model to obtain the optimum investment weightage for risky asset portfolio in maximizing the Sharpe ratio. Lastly, we apply the capital allocation between risky portfolio and risk-free asset to obtain the complete portfolio.
Moving on, here is the descriptive statistics for the first and the second sub-period for all of the 6 companies. And here is the correlation for the first and the second sub-period for all of the 6 companies as well. From the descriptive statistics and the correlation we found, we use the values to build our portfolio using 4 strategy, which is using the lowest standard deviation, highest mean, kurtosis, and also correlation. For the first sub-period, one of the portfolio we have is using smaller kurtosis, and from the descriptive statistics that we found, the companies we have chosen for this portfolio is Pan Malaysia and Asia. And from these 2 companies, we use Markowitz optimization model to see the weightage and the proportion that we need to invest. And it turns out we will invest 100% in Pan Malaysia. However, as you can see here, the Sharpe ratio is negative, which indicates a bad investment, and it shows that we need to invest negative 12.76% in risky asset. Overall, this is not a favorable portfolio for us to invest to. Hence, we invest fully in risk-free asset due to the negative allocation to P and negative Sharpe ratio. So, comparing to KLCI index, it seems that our risk-free asset has a greater return and it is also less risky too.
Next, for the portfolio of 2 risky shares, we decide to select Sein and Koba as these 2 shares are negatively correlated. So why we use negative correlation? Because we hope that the good returns will offset the poor return. So after we conduct the Markowitz optimization model, we have to invest 100% in Koba. And we can see here that the Sharpe ratio is less than 1, which means it is a bad investment. But we do not have other choice because during this sub-period, most company perform poorly. So next, when we compare the risky portfolio and the KLCI index, we observe that the risky portfolio has higher annual expected return than the KLCI index and it is less risky. So now we move on to the portfolio of 3 risky shares, and we decide to choose Asia, TNB, and Koba because these 3 shares have the highest average annual return. And actually, this portfolio will have the same outcome with the previous portfolio of Sein and Koba because these 2 portfolios suggest that we have to invest 100% in Koba, and we can see that the expected return, the standard deviation, the Sharpe ratio is the same. And we observe that this portfolio has the higher expected return than KLCI index and it is less risky.
Okay, so next, for this particular portfolio, we choose 3 companies with the lowest standard deviation with the objective, which is to analyze the shares with the lowest risk possible. TNB has the lowest standard deviation, followed by Asia and Pan Malaysia. The annual expected return is negative 0.33069 and the risk is 0.5389. The value of the standard deviation for this portfolio is among the lowest, considering the combination of TNB, Asia, and Pan Malaysia risk, but turns out its annual return is much lower compared to the KLCI index.
Now, I will present about the portfolios for the second sub-period. that is 1st January 2020 until 31st December 2021. So for the first portfolio of 2 risky shares, we choose the ones with positive correlations, that is Ukras Berhad and Sapura Energy. So by assuming 4% risk-free rate and investor risk aversion A is 10, after we done the macro risk optimization model, it results in for us to invest 100% in Ukras. As you can see from this table, the Sharpe ratio and also the optimal allocation to P give us a negative value that is less than 1. That is actually a bad investment. Therefore, we fully invest in a risk-free rate. So to compare between this risky portfolio versus KLCI index, we can see that this risky portfolio has higher annual expected return than KLCI index and is also less risky. Next, for the second subperiod of 2 risky shares, we choose the one with the smallest courtesies, that is PAN Malaysia and TMB. So the macro risk optimization model give us the results is to invest 100% in PAN Malaysia. We can see from this table here that this risky portfolio also shows that the Sharpe ratio and optimal allocation to P give us a negative value that is less than 1 and is also actually a bad investment. Therefore, we will fully invest in risk-free asset. To compare between this risky portfolio and KLCI index, we can see that risky portfolio has lower annual expected return than KLCI index, but is less risky.
For the second sub-period, we aim to obtain high returns. Therefore, we choose 3 companies with the highest mean of annual returns, which is Kobe, Ukras, and PAN Malaysia. With the assumption of 4% risk-free rate and investors' risk aversion of 10, we apply the macro risk optimization model, and the results suggest for us to invest 100% in Kobe, 19.13% in risky asset. When we compare the risky portfolio and the KLCI index, we discover that it is more favorable to invest in the risky portfolio since it provides a better expected return and a lower risk. Even if we invest in the complete portfolio, we obtain similar results as well.
For this portfolio, we again choose 3 companies with the lowest standard deviation. The lower standard deviation, the lower the risk of share price changes in the sub-period. So this time, based on the descriptive analysis, 3 companies with the lowest standard deviation are Asia, DNB, and SAN. For macro risk optimization model, we can see the results shown based on the table below. From all the ratio, we can see that the ratio indicates that this portfolio is not good for investment, as the expected return of the investment is very low. Comparing to the risky portfolio with the KLCI index, it seems that it was not favorable to invest in this risky asset. Hence, it is better if we invest fully in a risk-free asset. Moreover, the Sharpe ratio is also negative, proving that the portfolio's return will be negative and also give us information that the risk-free asset has a greater return than the portfolio return.
The analysis was divided into 2 sub-periods because we want to see the effect of COVID-19 Movement Control Order MCO towards the share prices and portfolio strategies among these companies. We can observe that Koba has the highest mean annual return for both sub-periods, which indicated that Koba is the most profitable even after the MCO was implemented. It is due to the fact that Kobe Technology is in the manufacturing industry of IT products. Hence, they have a lot of high prospects during COVID-19 as the economy in Malaysia is more technology-driven. Meanwhile, the lowest mean annual return for both sub-periods goes to SAN. It is due to the reason that Sapura Energy is in the oil and gas industry, which was among the affected industries during COVID-19. Next, we focus on 8 portfolios that have been constructed based on a descriptive analysis from both sub-periods. From these portfolios, you can see that for the first sub-period, portfolio number 1 and 3 have the highest expected return with the lowest standard deviation. This is a good indication that it is the most profitable with the lowest risk possible. On the other hand, for the second sub-period, portfolio number 7 has the highest expected return. Comparing both sub-periods, Portfolio number 7 is the most profitable of them all. We had adjusted the companies with the same technique of analysis and proven that during COVID-19, the investment prospects do increase as our profits increase as well. These three portfolios outperform the Kelsia index, which is a good benchmark, as this also shows that our strategy is following our main objective, which is to gain profits.
To sum up, various strategies can be used to form a portfolio, but it needs to be tailored according to our preference. As you know, descriptive statistics tell us the initial conclusion about the whole situation of the company, but still, we need to do calculation of expected return to see the actual situation of the company. We're delighted to be able to hands-on on this project because it is more applicable in our daily life. Hopefully, in the future, we can apply it in reality to build a portfolio that can provide the greatest return.